What if I told you the government has essentially written a secret instruction manual on how to pay them less money, and almost nobody reads it? That sounds insane, right? But it is completely true. The tax code in the United States is not just a list of rules about what you owe. It is also a roadmap filled with legal pathways to keep more of what you earn, and the people who understand this roadmap are quietly building wealth while everyone else is handing over massive chunks of their income every single April. Today, I am going to walk you through exactly how to do this legally, ethically, and most importantly, effectively. And before anyone panics in the comments, we are not talking about tax evasion. Tax evasion is illegal and people go to prison for it. What we are talking about is tax avoidance, which is completely legal, fully encouraged by the IRS itself, and used by the wealthiest people in this country on a daily basis. Stay with me because by the end of this video, you are going to see your tax situation in a completely different way. Let me start with something that will probably frustrate you. Most people think their tax rate is their tax rate. Like, if you are in the 22% bracket, you just pay 22%. Done. But that is not how any of this works. The United States uses a progressive tax system, which means you only pay that higher rate on income above certain thresholds. Everything below those thresholds is taxed at lower rates. So when you hear someone say they are in the 37% bracket, that does not mean every dollar they earned got taxed at 37%. It means the dollars above a certain level got taxed at that rate. This single misunderstanding causes people to panic about earning more money because they think it will hurt them. And that misunderstanding also makes people feel like they have no control. But you do have control, and understanding the system is the first step to using it to your advantage. Now here is where things get really interesting. The difference between someone who pays 30% of their income in taxes and someone who pays 10% is usually not luck or some fancy offshore scheme. It is almost always about understanding three things: what counts as taxable income, how deductions reduce that income, and which accounts legally shelter your money from the IRS. Let me break each one of these down for you, because each of these areas alone could save you thousands of dollars every single year. First, let us talk about taxable income versus gross income. Your gross income is everything you earn. Your taxable income is what the government actually taxes you on. And the gap between those two numbers is where your opportunity lives. Every legal strategy we're about to discuss is essentially about making that gap as large as possible. Think of it like a funnel. Money comes in at the top, and through legitimate deductions and strategies, less of it makes it to the bottom where it gets taxed. Your goal is to widen that funnel as much as the law allows. The single most powerful tool most Americans have access to and dramatically underuse is the retirement account. Now, I know that might sound boring, but stick with me because this is genuinely one of the most powerful legal tax reduction tools available to regular people. When you contribute to a traditional 401k or a traditional IRA, that money comes off the top of your taxable income. So if you earned $60,000 and you put $10,000 into a traditional 401k, the IRS only sees $50,000 of income. You just made $10,000 essentially invisible to the tax system, at least for now. As of 2026, the 401k contribution limit is around $23,500 for people under 50, and if you're over 50, you can contribute even more through catch-up contributions. If you're self-employed, the options get even more powerful with vehicles like the SEP IRA or Solo 401k, where contribution limits can go significantly higher. These accounts do not eliminate the tax forever. You pay it when you withdraw in retirement. But the deferral itself is enormously valuable because your money grows tax-free in the meantime. And in retirement, many people find themselves in a lower tax bracket anyway, so they end up paying less than they would have today. Now, let us talk about the Roth account, because this is a different strategy that works better for different situations. A Roth IRA or Roth 401k does not reduce your taxes today. You contribute after tax dollars. But here's the magic. Everything that money grows into is completely tax-free when you take it out in retirement. So if you put in $6,000 today and it grows to $60,000 over 30 years, you pay zero taxes on that entire $60,000. For younger people who expect to be in a higher tax bracket later in life, the Roth option can be extraordinarily powerful. And there's something called the backdoor Roth conversion that higher income earners use to get money into Roth accounts even when their income technically exceeds the eligibility limits. This is completely legal and widely used. Here's something that blows most people's minds when they first hear it. Capital gains taxes work completely differently from income taxes, and if you play your cards right, you might pay 0% on investment gains. I said zero. If your taxable income falls below certain thresholds, the long-term capital gains tax rate for investments held longer than 1 year is literally 0%. For a married couple filing jointly, that threshold is over $94,000 in taxable income as of current law. This is why so many wealthy people structure their financial lives around investment income rather than traditional salary income. They understand that a dollar earned from a long-term investment is taxed far more favorably than a dollar earned from a paycheck. You can begin doing this too by being strategic about when you sell investments, holding them for longer than a year before selling, and being mindful of your total taxable income in any given year. Now, let us talk about something called tax loss harvesting, because this strategy is used by sophisticated investors and it is completely available to you right now. Here's how it works. Let's say you have a stock or fund in your investment portfolio that has lost value. Instead of just holding it and hoping it comes back, you sell it and lock in that loss. That loss can then be used to offset gains you have made elsewhere in your portfolio, reducing your tax bill. And if your losses exceed your gains in a given year, you can even deduct up to $3,000 of those losses against ordinary income, with any remaining losses carried forward to future years. This strategy requires a bit of attention and coordination, but over time, it can meaningfully reduce what you owe the IRS while keeping your investment strategy intact. Now, I want to talk about something that is particularly powerful if you are a business owner or thinking about becoming one, because the self-employed have access to a world of deductions that employees simply cannot access. When you run a business, whether it's a full-time operation or a side hustle, legitimate business expenses become deductions. A home office used regularly and exclusively for business, business-related travel, equipment, software, professional development, advertising, even a portion of your phone and internet bills if used for business. All of these reduce your taxable business income. Now, this doesn't mean you should create a fake business or claim personal expenses as business ones. That's tax fraud, and it's exactly the kind of thing the IRS audits. But if you genuinely have business expenses, documenting and deducting them is not just legal, it's expected. The IRS literally built these deductions into the code to encourage entrepreneurship and business activity. One of the underutilized deductions for self-employed people and business owners is the Qualified Business Income Deduction, sometimes called the QBI deduction. This provision allows eligible self-employed individuals and pass-through business owners to deduct up to 20% of their qualified business income. So if your business earns $100,000 in profit, you might be able to deduct $20,000 of that before calculating your tax bill. This is an enormous benefit that many people are not taking full advantage of simply because they don't know it exists, or they're not working with a tax professional who understands how to apply it properly. Now, let us pivot to something that affects almost everyone watching this, regardless of whether you have a business: itemizing deductions versus taking the standard deduction. Every year when you file your taxes, you have a choice. You can take the standard deduction, which is a flat amount the government allows everyone to subtract from their income without documentation,
Or you can itemize, which means listing out specific deductions like mortgage interest, state and local taxes, charitable contributions, and certain medical expenses. The right choice depends on whether your itemized deductions add up to more than the standard deduction. For many people, especially homeowners in higher tax states who give generously to charity, itemizing can result in significantly larger deductions. The key is to actually track these things throughout the year rather than scrambling at tax time and missing opportunities. Speaking of charitable giving, there's a strategy called bunching that high-income earners use to maximize the tax benefit of their charitable donations. Here's the concept. Instead of giving a moderate amount each year, you bundle 2 or 3 years' worth of giving into a single tax year. This pushes your itemized deductions over the standard deduction threshold in that year, giving you a larger deduction. Then, in the years where you don't make those large donations, you take the standard deduction. Net result, you give the same amount over time, but you get a bigger tax benefit. And for even more flexibility, you can use something called a donor-advised fund to make that large charitable contribution in one year for the tax benefit, while distributing the actual money to your chosen charities over time. Now, let's talk about health savings accounts, or HSAs, because these might be the most tax-advantaged account in the entire United States tax code, and a huge portion of people who are eligible for them never use them fully or at all. To qualify, you need to be enrolled in a high-deductible health plan. If you are, an HSA gives you a triple tax advantage that's genuinely remarkable. Contributions go in pre-tax, reducing your taxable income right now. The money grows inside the account, completely tax-free, and withdrawals for qualified medical expenses are also tax-free. That's 3 separate tax benefits on the same money. And here's the little-known power move. Once you turn 65, you can withdraw HSA funds for any reason without penalty. Similar to a traditional IRA, you just pay regular income tax on it. So an HSA essentially transforms into an additional retirement account after 65. The annual contribution limits are a few $1,000s depending on whether you have individual or family coverage, and every dollar you put in is a dollar less the IRS sees. Let me talk about something that tends to surprise people.
The tax treatment of real estate. Real estate has some of the most favorable tax treatment of any asset class in America, and this is not an accident. The government has deliberately structured the tax code to encourage real estate ownership and investment. Depreciation is one of the biggest benefits. When you own a rental property, you can deduct the cost of the building itself over a period of years, even while the property might actually be going up in value in the real world. This depreciation deduction can offset your rental income, sometimes reducing it to zero on paper, even when you are cash flow positive. And there is a provision called a cost segregation study that allows real estate investors to accelerate this depreciation even further by identifying components of a property that can be depreciated faster. This is genuinely powerful stuff that sophisticated real estate investors have been using for decades. There is also the concept of a 1031 exchange, which allows real estate investors to sell one property and roll the proceeds into another similar property without paying capital gains taxes at the time of sale. You can keep doing this over and over, building up a larger and larger real estate portfolio while deferring the tax bill indefinitely. If you hold the properties until death, in many cases, your heirs receive what is called a stepped-up basis, meaning the accumulated gains effectively disappear from a tax perspective. This is one of the primary ways that multi-generational wealth is built and preserved in America. Now, I want to bring this back to something more accessible because I realize some of what we just covered might feel like it requires a certain level of wealth to access. But here's the truth. The foundational strategies apply at almost every income level. Maximizing your retirement account contributions, using an HSA if you qualify, understanding the difference between long-term and short-term capital gains, running a legitimate side business and tracking your expenses, making charitable contributions strategically. These are not things reserved for millionaires. They're available to people earning $50,000, $60,000, $70,000 a year, and they make a real difference.
The gap between someone who is intentional about this and someone who is not is often tens of thousands of dollars over the course of a decade, and over a lifetime, it can be life-changing. Let me talk about the psychology of this for a moment, because I think it is important. A lot of people feel guilty or uncomfortable about strategies to reduce their taxes. They feel like they are somehow cheating or taking something they should not have. I want to push back on that directly. The deductions and strategies we have talked about today were written into the law deliberately by Congress to encourage specific behaviors like saving for retirement, investing, giving to charity, owning property, and running businesses. When you use these strategies, you are doing exactly what the tax code was designed to encourage. And frankly, every dollar you keep and invest does more good than a dollar surrendered unnecessarily. You're not stealing from anyone. You are playing by the rules that exist. At the same time, there is a real line here. Tax avoidance, which is legal, is completely different from tax evasion, which is not. Hiding income, falsifying deductions, misrepresenting the nature of expenses, using illegal offshore schemes, these are crimes with serious consequences, including fines and imprisonment. Everything we have discussed today is on the legal side of that line. The goal is to understand and use the tools available to you within the law, not to break it. Here's something I genuinely want you to walk away with today. The complexity of the tax code is not an accident. It is also not your enemy if you understand it. Rich people do not pay lower effective tax rates than the middle class just because they have expensive lawyers doing something shady. They do it because they have people who understand the code deeply and apply it intentionally. The good news is that most of this knowledge is accessible to anyone who takes the time to learn it or invest in a good CPA or tax professional who specializes in proactive tax planning. And that brings me to one of the most important pieces of advice I can give you. There is a massive difference between a tax preparer and a tax planner. A tax preparer helps you report what already happened. A tax planner helps you structure your financial life in advance so that what happens is more favorable. If your accountant only talks to you in March and April and never reaches out the rest of the year with proactive suggestions, you might be leaving enormous amounts of money on the table. Find someone who thinks about your taxes year-round, not just at filing time. Let me quickly recap the key strategies we covered today so you have a clear action list. First, maximize contributions to tax-advantaged retirement accounts, like the 401k and IRA, choosing between traditional and Roth based on your current versus expected future tax situation. Second, if you are eligible for an HSA, fund it fully every year and treat it as a triple tax-advantaged retirement vehicle in addition to its medical use. Third, understand how capital gains taxes work and be strategic about holding investments for longer than 1 year to access more favorable rates. Fourth, if you have investment losses, use tax loss harvesting to offset gains and reduce your overall tax bill. Fifth, if you run a business or have self-employment income, diligently track and deduct all legitimate business expenses and look into the qualified business income deduction. Sixth, evaluate whether itemizing or taking the standard deduction is better for your situation, and consider bunching charitable donations in some years to maximize the benefit. Seventh, if you invest or own real estate, understand the power of depreciation, cost segregation, and the 1031 exchange. And eighth, work with a proactive tax planner rather than a reactive tax preparer. The average American pays somewhere in the range of 13 to 15% of their income in federal income taxes, when you account for all the various deductions and credits already in the system. But for people who are genuinely intentional and strategic about this, effective rates can be dramatically lower, sometimes in the single digits on income that, to most people, would seem substantial. That gap is not luck, it is knowledge turned into action. I want you to start somewhere today. Not next year, not when you make more money, not after you figure out some other piece of your financial life. Start now. Pick one thing from today's video, whether it's opening a Roth IRA, bumping up your 401k contribution, calling a CPA to discuss proactive planning, or doing some research on an HSA. One step puts you ahead of where you were this morning, and one step tends to lead to another. If this kind of content is valuable to you, drop a comment below telling me which strategy you're going to implement first. I genuinely read these, and your engagement helps me know what to cover next. If you want to go deeper on any of the strategies we talked about today, I have put together additional resources that can help you take action. And if you want to see more content about building wealth, understanding how money actually works, and making the financial system work for you rather than against you, make sure you are subscribed so you don't miss what's coming next. The best financial decisions you will ever make are the ones you make with the right information, and you just got a whole lot of it. Like, subscribe, and turn on notifications so you don't miss more videos helping you with investing, personal finance, and more. Check out this playlist of my top videos of personal picks, and I'll see you in the next video. Take care!